black screen, the sound of a ticking clock. A slow aerial shot of a glowing city skyline at night. Towers lit, highways alive, stock tickers flashing green. Everything looks like progress, but beneath the lights, the world is drowning in debt. Governments owe trillions. Corporations borrow endlessly. Households swipe now, pay later. And yet markets celebrate. Headlines call it growth. What if the prosperity we see is built on borrowed time? Centuries ago, money meant something simple: gold, silver, tangible value. Then came banks. At first, banks stored gold for safety. In return, they gave paper receipts. Those receipts became easier to trade than heavy coins. Over time, something subtle happened. Banks realized not everyone would withdraw gold at once. So they issued more paper claims than actual gold reserves. That moment changed history. Money was no longer just stored wealth, it became created credit. This system, fractional reserve banking, allowed economies to expand faster than physical resources ever could. Growth accelerated, so did risk. Fast forward to the 20th century, wars, industrialization, globalization. Governments discovered something powerful. They could borrow to fund expansion. Build roads today, pay later. Stimulate the economy during recessions. Print money if needed. In 1971, a historic shift occurred. The US dollar was no longer backed by gold. From that point on, money was backed by trust. Trust made expansion nearly limitless. Central banks could lower interest rates, encourage borrowing, boost spending. Debt stopped being a temporary tool, became the engine. Imagine this. A government borrows $1 trillion to stimulate the economy. That money flows into businesses. Businesses hire workers. Workers spend money. Markets rise. GDP increases. But GDP measures activity, not whether that activity is sustainable. Borrowed money looks identical to earned money in economic statistics. That's the illusion. Debt creates growth today. By pulling tomorrow's demand into the present, the problem, tomorrow eventually arrives. History has warnings. The Great Depression, the 2008 financial crisis, sovereign debt crises across continents. Each time the pattern repeats. 1. Easy credit. 2. Asset bubbles. 3. Rising optimism. 4. Shock. 5. Collapse. In 2008, cheap mortgages fueled a housing boom. Homes became investments instead of shelter. When defaults began, the system cracked. Banks failed. Markets crashed. Governments intervened. But instead of reducing debt, more debt was created to fix it. The machine didn't stop. It expanded. After 2008, interest rates fell to historic lows. In some countries, rates went negative. Money became almost free. Corporations borrowed to buy back their own stocks. Governments borrowed to maintain spending. Consumers borrowed because monthly payments looked affordable. Stock markets soared. Real estate prices climbed, but underlying wages not rising at the same speed. Productivity often stagnant. Much of the growth came from leverage. It felt stable because central banks stood ready to intervene. Markets stopped fearing risk. They feared missing out. When too much money chases limited goods, inflation rises. For years, inflation stayed low. Technology and globalization kept prices stable. But when supply chains broke and stimulus flooded economies, inflation returned. Suddenly, the cost of food, housing, and energy climbed. To fight inflation, central banks raised interest rates. And here's the hidden danger. When rates rise, debt becomes expensive. Governments pay more to service loans. Corporations struggle with refinancing. Consumers face higher mortgage and credit costs. System built on cheap borrowing begins to strain. If debt is risky, why does the world keep choosing it? It's because it works in the short term. Debt creates immediate results. Growth looks strong. Unemployment falls. Markets respond positively. Politicians operate on election cycles. Corporations operate on quarterly earnings. The future is discounted. Present is rewarded. And so the machine continues. Is debt inherently bad? Not necessarily. Debt can fund innovation. infrastructure, and opportunity. The issue is scale. When total global debt exceeds global GDP many times over, sustainability becomes a question. Can growth outpace interest forever? Can confidence last indefinitely? Or is the modern financial system balanced on trust that must constantly be reinforced? Return to the glowing skyline at night. Everything still looks strong. Traffic flows, screens flash, construction cranes rise. But beneath the surface lies an invisible web of obligations, promises of future payment. The modern economy runs on confidence. As long as people believe debts can be repaid, the system holds. If belief falters, everything changes. Debt is not just a financial tool, it is a bet on the future, and the world has placed the largest bet in history. The question is not whether the system works, it's how long it can.